Good afternoon, everybody. Welcome to Liberty Call. Today is Friday, November 10th, 2023. Hope everybody's having a fantastical day out there in the interwebs. It's a beautiful day here in Colorado again. A little chilly outside in the shade, but clear skies, snow's melting away, which is nice, and ready for the weekend. Hope everyone out there is, ready for their weekend too. Got some chores on the table. Got to do some sanding and painting and stuff like that. So, yay! Anyways, if it is your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could do me a favor, yes, you in the yellow shirt, give me some thumbs up, likes, shares, subscribes, follows, press the notification bell. All right, let's go ahead and get into the numbers for today. Looks like here in America, everything was in a good mood. Rest of the world, not so much. All right, Dow Jones was up 1.15%, 391 points, closed at 34,283. S&P 500 was up 1.53%, closed at 4414. NASDAQ up 2.05%, closed at 13,798. The VIX fell 7.39% today. It's down to 1416. Canada up 0.34. Brazil up 1.33. And Mexico up 0.44. Now to the less good news. Over in Europe, Germany was down 0.77. The UK down 1.28. France down 0.96. Netherlands down 0.38, Spain down 0.36, Italy down 0.49, Switzerland down 0.84, and Portugal down 0.27. Russian exchanges were mixed. MOEX barely up 0.07, the RTSI down 0.13. And the Asian markets, the Nikkei in Japan was down 0.16, Australia down 0.55, New Zealand was down 0.52. In China, the Shanghai was down 0.47, the Shenzhen Component down 0.53, China A50 down 0.8, DJ Shanghai down 0.55, Hang Seng down 1.87%. So, yeah, looks like the rest of the world did not get the memo that we got here domestically that, the markets are in a much better mood. So, but those things do happen. All right, well, let's check out and see how the markets did for the week. Let's start out with the Dow Jones. Let's see here. All right, there we are. Looks like it's going to finish the week in the green by about 0.54%. So even though we had a huge day today, the rest of the week kind of took that away. S&P 500 is going to finish the week up 1.18. The NASDAQ going to finish up about 2.12%. The Dow Transports, where is it? There it is. It's going to finish in the red by 0.61, and the Dow Utilities way in the red, 2.58%. So, all right, well, let's take a zoom out and look and see how things are doing on a trend basis. Let's back out here. We're in the Dow. All righty. Put our lines back in. All righty. So looking at the beginning of the downtrend at the beginning of last year, again, I've said this probably 1,000 times by now. We were a downtrend most of last year on the Dow, broke the downtrend in the fourth quarter, had a sideways market, and then started a new downtrend in August. What was it, about August 1st-ish, and then broke the upward resistance line about September 20th. The same day that Powell spoke after the September meeting. Same thing with the S&P 500 chart. Looks very similar. It happened it only broke the downtrend in the first quarter of this year. And then same thing, kind of sideways up, a little in the late summer. I think, again, I've said that was probably on hopes that the Fed was going to cease their rate hiking cycle, which, we're going to touch on that in a few minutes. We don't even know if we're there yet. So, and then zooming in, same thing, broke the upward trend on September 20th. So we'll see what happens. Been kind of out here in sideways land the last few weeks, so not sure where that's going to go. All right. Well, that is the markets for now. Let's go ahead and get to the economic data that came out this week. It was a pretty light week. Start down with the initial jobless claims. They came in at 217,000. Forecast was 215, and the last week's number was 220. Continuing claims came in at 1.834 million. Forecast was 1.82. Last week's number was 1.812. So it went up by about 22,000 there. And consumer sentiment came in at a 60.4 number. The forecast was 63.7. And last month's number was a 63.8. So consumer sentiment's been sliding here since it peaked out in July in the summertime. So now understand this is just a sentiment poll. It doesn't really have any real data in it. But anyways. All right, let's go and get over to the market recap for today. U.S. stocks shake off Powell's hawkish comments as tech leads the rally. All right, on Friday, U.S. stocks rebounded, particularly in the tech sector, following a previous day's dip. The shift came as investors assessed less hawkish comments from Federal Reserve officials after Chairman Jerome Powell's reminder that rate hikes are not concluded. Atlanta Fed President Raphael Bostic offered a more dovish perspective, stating that the Fed could reach its 2% target without any further action, as the full impact of recent rate hikes needs more time to affect the economy. Despite Powell's less optimistic view on Thursday, indicating the Fed's uncertainty about reaching a sufficiently restrictive level of rates to curb inflation, investors only slightly increased expectations for a rate hike in January from less than 1% to a 19% probability. The market rebound was led by a rally in big tech, with Microsoft taking a prominent role in the upswing. In earnings news, Plug Power experienced a significant decline of 39% after its third quarter revenue fell short of estimates due to hydrogen supply shortages. Apple agreed to a $25 million settlement with the Justice Department over allegations that the company favored hiring immigrant workers for certain jobs. Despite the settlement, Apple's shares rose by 1%. However, not all companies fared well, as Plug Power's disappointing results led to downgrades from Wall Street analysts. Illumina Inc. also faced challenges, falling over 9% after reducing its annual guidance due to Q3 revenue missing expectations, with the company citing a challenging macroeconomic environment affecting demand. In the oil market, prices rose on Friday, but were still on track for a third consecutive week of substantial losses, driven by concerns over slowing global demand and renewed fears of rising U.S. interest rates. Both benchmarks were down over 5% for the week, signaling the potential for the longest weekly losing streak since mid-April to early May. I mean, is anyone really sad that oil prices? I mean, if you're invested in oil, you're not real happy about it. But, for the bigger picture of things, I don't think anyone's sad that energy prices might be coming down, especially with it doesn't appear that the Hebrews and the Palestinians are, that little thing is going to cause any sort of oil disruptions, at least at the moment. And, as far as China, being the biggest consumer of oil products, I really don't see their economy slowing down too much, but we shall see. I mean, there's a lot of speculation out there that China is, basically a paper tiger, and a lot of their economy is just built on, leverage and things like that. So, all right, let's get to our next article here. America's growing economy, brought to you by Visa and Mastercard. Yeah, people aren't spending money that they've earned; they're spending money that they don't have. All right, the U.S. economy is seemingly thriving, with spending cited as a key indicator. However, the underlying reality reveals a precarious situation, as Americans are heavily reliant on borrowing to sustain their spending habits. Total household debt reached a new record of $17.29 trillion in the third quarter, marking a $228 billion increase. Credit card balances surged by 4.7% to a record $1.08 trillion, led this expansion, with a year-on-year spike of $154 billion, the largest since 1999. That was a good year. The challenge intensifies with rising interest rates, as average credit card interest rates hit a record of 20.72%. Americans paid a record $130 billion in interest and fees on credit cards over the past year. While the economy appears resilient, fueled by credit card debt and buy now, pay later plans, the sustainability of this model is questionable. Americans, having depleted approximately $1.9 trillion in savings over the last 2 years, turned to credit cards as prices soared. The surge in household debt is reflected in various categories, including mortgage balances, $12.14 trillion, home equity lines of credit, $349 billion, auto loans, $1.6 trillion, and student loans, $1.6 trillion. Despite the appearance of economic growth, signs of strain are emerging, with delinquencies rising across debt categories. Millennials, those with auto loans or student loans, are particularly affected. The surge in credit card delinquency rates, especially in the 30 to 39 age Group raises concerns about the sustainability of the debt-fueled spending spree. As Americans struggle under the weight of escalating debt amid rising interest rates, the Federal Reserve faces challenges in addressing persistent inflation. The conundrum raises questions about the longevity of this illusion of prosperity and the economic growth built on soaring levels of debt. Yeah, and if you come down here, you can see, where was it? Here we are. Let me make that bigger for you. So it shows here that from Q3 of last year to Q3 of this year, mortgage debt delinquencies in this case were 0.5% of total mortgage debt. It's gone up to 0.72. HELOCs have actually gone down. Student loan debt delinquencies have gone down. Auto loan delinquencies have gone up from 2.02% to 2.53%. And credit card debt has gone from a delinquency rate of 3.69 to 5.78. And if you were to, cumulative, we've gone from a 0.94% delinquency rate to 1.28. So, like I said, in previous broadcasts, that you can look at the delinquency rates of most loans, but credit cards are a good thing to look at because those are the most easily accessible for people. As those fall further and further into delinquencies and those into further down the queues, typically the worse the economy is doing. All right, well, let's go ahead and get to our last thing that we were going to talk about. It is it's from the Peter Schiff podcast. It's broadcast on November 6th. It was titled "Fed Won't Achieve Either Mandate." It was episode 929. We're going to listen to a couple of minutes of this and then let you guys get to your weekend. So let me mute my microphone so we don't get any feedback.
Just over 6 weeks to do that. That is a rapid pace. That annualizes out to more than $5 trillion a year addition to the national debt. So we are blowing up the debt. We're increasing the debt much faster than the official budget deficits, which are still showing just under $2 trillion. We're more than double that amount, and we're not even officially in a recession yet, although I believe that we are in recession. And in fact, the official recession may have already started this quarter. And I think this jobs report is a good indication of the recession. The fact that only 99,000 private sector jobs were created, and pretty much all of those jobs went to people who already had jobs. These are second jobs. These are third jobs. We had a huge surge last month in the number of people who have multiple jobs. 396,000 more people in October took on a second or a third job. This is a record high, 8.5 million moonlighting Americans working multiple jobs. In fact, if you go back, and I wrote this number down, since April of 2003, according to the government, 1.234 million jobs were created, but only 191 more people actually were working. How is that possible? Right? How could you create 1.2 million jobs but only get 191 more workers? Because the jobs went to people who already had jobs. So we don't have new people in the workforce. We just have people in the workforce working more jobs. And again, I've explained in the past, that is a sign of weakness, not strength. The fact that people can no longer pay the bills with one job, the fact that you now need 2 or 3 jobs to cover the expenses that you used to cover with one job, that's not a strong labor market. That is a very weak labor market because labor, the return on labor is collapsing. Workers can't earn enough money to pay the rent, to pay all their other bills. I just got today, just before I went on this podcast.
All right, we'll stop that there. He's going to go into a talk about how his property insurance has been going up. And but yeah, that's definitely some. That's what I like about Peter. He really dives into the numbers, and because if you just get the headline numbers, hey, X number of jobs have been created from this point to this point. Well, he digs into the numbers and actually sees, well, yes, correct, but not accurate. I mean, there's more jobs, but there's not more people employed. So, it's just more people taking on more work. So anyways, it's a good listen. So, it's about an hour long. If you listen to it at, 1.5 speed, like I normally do, you can get through it in about 35 minutes. So anyways, well, that's everything that I had for today. If anyone needs anything from me, go to dsafinancialgroup.com. All my contact information's there. Hope you have a wonderful weekend, and I shall talk to you next time. Adios.